Hello, and welcome to the Wealth Management Invest podcast. I'm your host, David Bodamer, with the editorial team at wealthmanagement.com. I oversee our investments coverage. And for this latest episode, I am happy to bring on Jake Miller, who is co-founder and chief solutions officer at Opto Investments. Hey, Jake, how are you doing?
Doing well. Thanks for having me.
So before we got some news to discuss. We got some, want to pick your brain a bit about what's going on in the private markets and how RIAs are accessing opportunities. But before we jump into some of that stuff, if you wanted to, I just wanted to give you a chance to maybe say a little bit about yourself and about a little bit about Opto for folks who may not have be familiar with you guys.
Yeah, so I founded Opto 3.5 years ago now with Joe Lonsdale, founder of Palantir, Adipar, 8VC. And we shared a view that the private market space was fundamentally broken, especially in how it worked with the wealth community, with misaligned incentives, bad technology, and the quality of options just really not where it could be. And so put our heads together with some technologists as well and focus on building the Fiduciary's private markets platform. And so we are 100% aligned with clients. We don't get paid by GPs. They sometimes try, but that's not how
Mhm.
we work. We are aligned with our clients and their end clients and bringing just the best of private markets to bear and doing that with scale and efficiency through true platform technology versus sort of a rickety system. Prior to that, I was an investor at Bridgewater Associates, the macro hedge fund. That was really where I started thinking deeply about private markets. I was responsible for some of our research and investment on the risky credit side, corporate credit and high yield, and kept seeing it. Even when we got credit conditions right, a lot of the price action would show up on the private side, not the public. And so that ability to generate more alpha, but the need for great data to support that, having a systematic process, and the desire to bring that sort of approach to a space that has historically been sort of sold, not bought.
Right, right. So, gonna want to pick your brain a little more about some of that stuff, and as we get into the conversation. But where I thought we could start was we're recording this like first week of June. Those probably published in a little bit of a delay, but just for just situating people with when we're talking. And you guys this week were part of an announcement with Mercer Advisors and a new part and a new thing that they're rolling out for qualified purchasers. Can you talk a bit about what's going on there?
Yeah, so we're super excited to be partnering with Mercer to launch the Aspen Funds platform. And as you stated, that'll be, to start at least, QP products that are diversified baskets of private markets opportunities. And so those can be thematic, growth and income, asset class specific, venture, private equity, real estate. And then we're also going to be providing the ability for ultra high net worth families they work with to create their own custom sleeves
Mm-hmm.
and bringing a really scalable approach to customization to a large and rapidly growing firm. Partnered really deeply on this across all steps of the investment process and share a commitment to being true fiduciaries in the space. We basically took, like these things all do, months and months really of not
Mm-hmm.
just building out the technology, but building out a partnership framework that was going to be built for the long run and was not going to incentivize any of the behaviors that both of us are trying to really undo in this space. And so,
So,
yeah,
sorry. Yeah, go ahead.
no, just I think it's a great proof point for us. They're 60 billion plus and growing quickly, working with 30,000 plus families, and the fact that our technology can easily step up to the plate is an encapsulation of what Joe and I set out to build, and we're super excited to be aligned with a forward-thinking partner there.
So yeah, I was just going to ask, when did you mentioned that the conversations were happening over months, but when did this all like start and who approached who? Was it something that they reached out to you on or vice versa? How did this kind of come about?
Yeah, so uh, back in 22, end of 22, Mercer acquired an RIA called Regis, led by Bob Burleson, Peter and a few others, really for their private market specialty. It's really more of an MFO model. They work with a lot of clients who themselves are private capital managers and have a really great network in venture and private equity and beyond. And I'd known Bob for a little over a year at that point. We'd met at various investor events, and he was excited about what Opto was doing at the scale that Regis was working at. The technology might be kind of cool, but not strictly necessary. But when Regis was acquired by Mercer, and the thoughts from Daniel, the president, and Don, the CIO, were to really grow this into a true platform, I think it became clear to him pretty quickly that they needed a real solution here. And one thing that is always nice to hear when you found a company, he frequently says to me, "I've been waiting 25 years for Opto to come along." And so he brought that to Don and Daniel at Mercer, and then they reached back out, which is always a fun experience when you're building a company to have one of the largest potential clients come to you.
Absolutely.
And from there it was really deep partnership. There's a lot of deep values alignment between our firms and between myself and Daniel, and that let us really take down. It wasn't a negotiation. It was a true partnership from the start. How can we make sure both firms benefit from this in a robust way that scales over time while delivering the best solution for their families?
So, pivoting to then, some of the bigger picture, I guess this deal does speak to what a lot of people are talking about, what I've had, several episodes talking about, whether you want to call it private markets or alts, but just this opportunity that everybody seems to be seeing for the wealth space to really have more access, to increase allocations to private markets. And so, what do you think? Where are we in this process of the wealth channel coming in, understanding the opportunity set here, and bringing these things to incorporating this into client portfolios?
Yeah. So I think we're in phase 2 of this story. And what I mean by that is, if we rewind the clock to 2008, prior to that, there'd been a good deal of sort of hedge funds marketing into the wealth channel, and a lot of that blew up pretty tragically in the financial crisis. But really basic, almost no access to private markets, and the private markets themselves were quite a bit smaller. And so coming out of that, in 2010, 11, 12, some other early movers and competitor platforms started to work with the larger funds to create access points for individuals, high net worth, RIA. And when that was the only game in town, I still think, even private market beta is very useful to add to portfolios.
Mm-hmm.
But we're not in that inning anymore. I mean, you have some of the largest funds in the world are now coming out of retail with all the REITs and BDCs.
Mm-hmm.
Access is no longer, just access to private markets is no longer a differentiator. If I'm going to try and win an ultra high net worth client as an RIA, I can't walk in and say, I can get you access to, this interval fund that, hey, guess what? You can just go onto the internet and buy it yourself.
Right.
So we're in phase 2. And I think that what I'm seeing is kind of 2 paths you can go on, and you can do both, but you're seeing the start of a compression in what it costs to get into what I'd call broadly private market beta. And so very big funds, evergreen, you really, if the fund you're in is party to 30% of real estate transactions in the country, you can't expect it to be much more than real estate beta, but it's still diversifying. I think it still has a role in portfolios. It just needs to come down a lot in price.
Mm-hmm.
Like public market beta, you just shouldn't pay too much for it. And then, where we come in and where we fit in the ecosystem, and where, what Mercer is thinking about and our clients in general are thinking of is, well, what about the alpha side? And so, I have a very simple framework, which I use a lot to explain why I'm so excited about this space versus where I came from in public markets. And that is, I think there's really only 4 sources of outperformance. You can have unique information, unique insight, unique access, or luck. Probably don't want to bet the farm on luck.
Right.
And unique access and unique information are illegal in public markets. Yeah. Do not pass go. Do not collect $200. Go straight to jail when you get caught. But that's the lifeblood of private markets. And so, whereas in publics, you really have to be all in on unique insight. And look, I did it for years. It's really interesting stuff. It's also really hard. And the market is always trying to catch up with you and always generally able to catch up with you. But access and information actually tend to be sort of, they build on themselves. And what I mean by that is, this isn't some nefarious backroom dealing stuff here. We're talking about something as simple as if I backed the last great health tech company, and that was 3 years ago, and they're a unicorn now, and everyone's thrilled, and everyone's writing about how my VC backed this company early. What's the next great health tech coming out of Stanford PhD and a business guy meet up and have the next best idea? They're probably going to want to talk to me first because it's a stamp on their company to be backed by the person who backed the last great one. And when they come to me, I have more information on the space because I have live investments in that sector. And so I can better estimate margin, TAM. I might know some potential customers with crossover with my other portfolio companies. And so it's not zero sum. Those founders can get more out of it. And I can get access at better pricing and better information on deals than the rest of the market. And so what you see is private markets having a slightly more robust access point to sustainable alpha. And if you take on the growth side, so venture and private equity, if you have a top quartile fund, the odds that the next fund is top quartile is greater than 70%, with a very important caveat that they can't be growing too fast. And that depends a little bit on space, what too fast is, but that number, that 70% number drops to basically zero if they're growing more than, call it 100 to 120% fund over fund, which, look, it's really hard to avoid that temptation, right? If you just crushed it, you had a 40% IRR fund, you could raise $1 billion. That can be a hard thing for people to turn down. But what we find is people who are really committed to asset management versus asset gathering can stick to a path that really leans into those unique differentiators of access to information and helps them maintain an edge over time, which leads to sustainable private market alpha, which, look, comes with things that you have to accept that aren't on the drawdown side. Like, it's going to be a liquid. You can't fundamentally make these things liquid. And there's behaviors that you don't want to avoid that liquidity requires. We can talk more about that if it's of interest to the platform, some of the drawbacks there. It's going to come with higher fees, and so you have to just look at, like, does the net return make sense? And am I getting truly diversified return? Like, what I should be hoping for is real alpha here, so uncorrelated to the rest of the market, and high positive expected value, which we think is only possible consistently in sort of the more unique. I don't want to say niche because some of these things are down the middle, but the teams are really exceptional and have defensible edges that are going to lead to outperformance through time.
And when you're talking about private markets, you're looking across like all of the asset types, right? Like private equity, private real estate, private credit, hedge funds, VC, anything else I'm missing in there?
Yeah, so I mean, hedge funds, it depends. Some of them are purely public, some do crossover stuff. But in general, our 5 core sleeves are basically ones you stated. So venture, private equity, private credit, real estate, and infrastructure.
Oh, infrastructure. Okay.
We do research and work for clients outside of that, but our core focus is on private markets investments that create something that wasn't there before. And so long short hedge fund certainly has a place in a lot of portfolios, but I think predicting outperformance there is harder, whereas in those pure private sleeves, there's less access to the best of it today, and so there's a bigger gap to fill with in current client portfolios. And the stability tends to be a little bit higher.
And you made some reference to like the semi-liquid structures that are, suddenly very popular and being launched seemingly on a daily basis. But you're looking at like everything, the traditional kind of, the stuff that qualified purchasers are buying into, not just these somewhat newer things that are available even down to the accredited level.
Yeah, and we're almost exclusively looking at that. If someone has a mandate, we will certainly flex our diligence muscle and try and find the best thing in that category. But that said, our pretty strong view here is that if you are not even qualified purchaser, but qualified client and above, and
Mm-hmm.
that's 1.1 with the RIA or 2.2 overall, you probably have an illiquidity budget. Now, this is why it's important to be working with an advisor. This is where planning becomes really important and helping them understand, like, what can I actually afford to not access for 3, 5, 7 years. But once you know what that number is, be it 100,000, 500,000, a million, you want to get the most bang for your buck from that illiquidity. We don't think you get that in semi-liquid structures
Mm-hmm. Mm-hmm.
for a few reasons. So one, if I'm going to have the ability for people to have ongoing liquidity, I need to maintain a pretty high cash buffer, and that eats into returns. And now I'm paying someone high management fees to hold my money, some portion of my money in cash, which I don't love.
Right.
There's counterparty risk involved as well. I mean, we're seeing it with S-REIT today, but a bunch of other REITs and BDCs over the last few years. If people start heading for the exits to meet those liquidity needs, you sell the best things first because they're easy to sell. And so if you're not one of the first movers, you're left with the stuff that's going to be a lot harder to sell and is certainly going to be sold at a loss. Um, and those are risks that if you have an illiquidity budget, you just don't have to take. It
Mm-hmm.
takes 3, 5, 7 years for a business to prove itself, but it takes a business cycle often. If you have patient capital, and this is for retirement, this is for your legacy, this is for philanthropy, the reward for that patience can be very high.
Yeah, I think this segues with, I think, a term that you guys use about like having this fiduciary first approach, right? Around, so like not just, which I guess, so not just like thinking about like this is a buzzy area, so you should be thinking about it, but actually, really having a responsible discussions with and the clients who this is appropriate for, and just really being thoughtful about how folks are getting in here.
Yeah, that's really our DNA of, like, if we went out and raised a BDC, maybe not today, but like last year, we probably could have raised a lot of money quickly. We, have a great network, both on the demand and supply side. Everyone was doing it. We just, one of our core values of the company is courage, and it didn't feel very courageous to just follow the trend there. When, if we were going to look back in 5 years, that wasn't going to be the best partnership to hold with our clients. And so, this is part of why we capitalize this business so well. We've raised about $180 million to date. And that's so that we don't have to be seeking out, the next dollar. We need to be thinking about how do we make this business the most valuable in 10 years. But our strong view is that the way to do that is by being the best partner, not by getting the most out of the next transaction.
And so, what are the next steps for Opto?
Yeah, so we are quickly heading into multi-billion-dollar territory with commitments and stuff outstanding. I'd say a lot of startups, I kind of think about it like breathing almost, where you need to build and then you need to solidify. And so the build, you breathe in, things expand, you build new tools, you try new client types. And when you find stuff that's working, like we have right now with Mercer and a number of other large partners, you need to make sure you protect the ship. And so you take tools that were maybe scrappy developer tools, and you harden them and you make it something that people can rely on a day-to-day basis. You improve security, latency, just take everything that's working and make that as robust as possible. And so right now, I think we're the next 6 to 9 months in that sort of consolidation phase and taking everything that we know is working and making sure it's never going to stop working. But as we think farther out, there's some really cool technology on the horizon that I'm excited to start rolling out to people. We realize there really isn't a good CRM or workflow system for diligence. So we just built
Hmm.
it ourselves, where you can forward a deck you're sent to an alias, and it will you can use AI to scan the 4-pager PPM deck, pull that into a secured master security list, and then benchmark that versus everything else you've ever been sent and every fund that's in our database. So you can see like, hey, these PPM terms are a little out of line. These fees are not client friendly. All that happening on the fly. We don't think AI is going to replace like the human touch in late stage diligence, at least anytime soon. I personally wouldn't put money to work without looking someone in the eyes, but it
Hmm.
really helps in screening. We get sent over 1,000 deals a month. It's really hard to go deep on all of those, but if you have the right tools, you can know which 100 you do want to go deep on, and that's possible. And a lot of our clients face that same issue. And so one of the cool things about being a fiduciary, just like our clients are, is we get to build technology that solves our internal problems. And then when we look up, we're like, hey, I actually think this would make a lot of our clients' lives better. But then you think about how businesses grow and evolve, that diligence toolkit might be really useful even outside of the RIA space, working with other fiduciaries in endowments, philanthropy, et cetera, where like we see a lot of junk today, to be honest, in some of the OCIO space and stuff like that. And I like bringing a little bit of clarity and common sense to spaces that maybe have been a little lazy for too long.
Yeah, that sounds good. Um, in terms of just like the private markets overall, what is what are some of the big themes that you've seen in 2024? Are there is there interest in certain of those asset types more than others right now?
Yeah, so I'll give you two sides of the equation. There's what are we
Hmm.
hearing in terms of demand, and then there's what are we high confidence in as where you want to be deploying or not deploying right now. So on the demand side, I think with yields higher for longer, there's been a pivot away from some of the evergreen uh, yield-oriented products, which has led to some pain in those areas as well. But we're getting a lot less inbound on, what are you doing in that space when, the curve is flattened a little bit, and I think people are broadly accepting, that they're going to have, well, harmful in some ways to the economy, but, nice rates of return on a, 1-year CD for a little while here. So like it's definitely been more oriented around growth. And I think, things like the NVIDIA run and
Hmm.
uh, other sort of very growthy stories help contribute to that sense of FOMO and wanting to figure out how to participate in the upside. Now, this is an interesting time because it's not like we have a broad-based, well, somewhat broad-based, but it's not all winners, right? It's not one of those periods where, concentration in the S&P is very low, and in 2016 to 19 period, like everything went up with each other. This is a lot of winners and losers. Um, and some of those winners are, maybe pushing, and this is in private and public, pushing the limits of feasibility on valuation, et cetera, to the point where I think some forward-thinking folks are thinking, what comes next? What's the next, is there a next shoe to drop, and what would I do about it? And so, we see there is an opportunity to work with more activist style private equity managers on that side, where these are folks who can do turnaround, do transformation. If a company IPOs and it's down 78% within 3 months, they can take it back private and actually extract some value from it. And so you have multiple ways to win,
Hmm.
which we like. So this isn't growth private equity. It tends to be more in the LBO space, but it can be sector concentrated. We work with some groups who do just financials,
Hmm.
technology, but also just great lower middle market stuff. And as capital has become scarcer and more expensive, you've seen more business models come under pressure, which is definitely a short term, can jostle things up, but creates opportunity for those who know how to do it. And so we look for people who've traded through a cycle. Maybe it's a new firm, it could be their first fund, but it's someone who can show you an auditable, attributable track record of what they did the last time capital got tight. Um, Early stage venture, is a interesting space right now. I wouldn't do anything that's backing like an OpenAI competitor. That's going to be a little overpriced, but
Mm-hmm.
outside of generative AI, diligence timelines have basically doubled since the peak froth in 2022, tripled in some cases. Valuations make sense. You can get a significant portion of a seed or A company for a reasonable 5, 10, $50 million check versus having to do 50 before. And there's no deficit of good ideas. Early stage venture is one of the more alpha areas in private markets, and I mean that both positive and negatively. The dispersion between top and bottom quartile early stage is a little bit above 30%. And so you really want to make sure you're in that top quartile because very little of your return comes from beta. It's so much about competition, market dynamics, picking winners. So it's both a little bit recession proof in that you don't have a big beta exposure, but you really need to have trust in your partners and know how to source, evaluate, diligence those firms, and then how to do that on an ongoing basis. Back to that earlier discussion, how do I know that they're not growing too fast? Do I want to do fund 2, fund 3, fund 4?
Mm-hmm. Well, I've taken a pretty good chunk of your time here, so just wanted to, and you're giving such great depth in what's happening in these private markets. I appreciate it, but just wanted to, before I wrap up, maybe just give you a chance to touch on any points that I haven't asked you about, or any kind of like final takeaways for the audience.
Yeah, I would say, I would stress people to really recognize that we are in phase 2 here, and that you don't have to accept the private markets that are being sold to you. Where we now have enough data, transparency in the space, there's enough activity that you can demand that these things actually make sense for portfolios. We're not the only group that does this, and there's various groups I respect. It's nice to be in an evolving space where there are people really trying to fix the hard problems.
Right.
But
competition can breed, real improvement, right?
Yeah, my dad worked for Visa for a number of years. He's still there, 20-something years. And one of their internal things is, American Express isn't our competitor, cash is.
Mm.
Like, we all benefit if people trust, and this was maybe more relevant 10 years ago when people actually still use cash. But, the idea was if everyone trusts just carrying around, their card, we all win. And, I want to see this space evolve in the same way, where trust should become more innate versus how I think it is today, which is, if someone walks in off the street and they're wholesaling you something, you should take it with a very big grain of salt. If anyone is interested and wants to hear about a more fiduciary-first approach, we're here. Even if it doesn't make sense with us, like, I want to see fiduciaries win and partner with each other to improve this space as a whole.
We're going to put some links in the show notes to Opto and I think social links and things like that. But, if there's any other ways people can reach you.
Yeah, we have there's a form on the website or LinkedIn. I'm sure there'll be stuff, but we've got a large team of people who are better at email than I am to make sure things get handled.
I hear that. Well, Jake, thank you so much for, answering all my questions and taking the time to come on our podcast.
I appreciate it. It was great. Thank you.
And David, how can people get in touch with you if they have more questions?
Yeah, you can find me on LinkedIn or through wealthmanagement.com. And still have a Twitter account, although a little less active these days.
Okay, well, thank you to you both, and thank you for listening today. Please follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.